let's move on. The numbers on the government's rescue plan are simply staggering. The Milken Institute out in Laura's hometown of Los Angeles thinks that the total numbers so far committed to help banks, automakers, and consumers, $7.5 trillion with a T, trillion bucks. A king-like sum, but is the money actually doing what it's supposed to do? Get credit flowing again. Robert Maltbie of Singular Research joins us now with more. He's in San Fran now. Robert, listen, do you think that this money is actually being put to good use, or is it just going down the taxpayer drain?
Brian, we're a little queasy in the stomach about the TARP. In fact, we're calling it the BAR, the Bank Asset Rescue Fund. We see the money not really reaching its intended sources, the home owners in foreclosure and the businesses, the small businesses that need money. Instead, it's being diverted to help banks bail out their balance sheets into SIVs, VIEs, and acquisitions. Today, a great example in the Wall Street Journal, you're seeing Goldman Sachs getting made whole by AIG on a bet they made in the CDS market. So, in fact, we're not real pleased in what we see happening. We think also the taxpayer is getting hit twice. On the cost of the imminent foreclosures and bailing that out. Also, they're getting shorted on this investment in the TARP. When you look at this,
Robert, first, but let me just interrupt. But the whole point of that rescue was to keep the financial system from collapsing, and that is the banks. So didn't it accomplish that? I don't know about you, but I'm not waking up in the morning thinking my bank's going to fail.
I'm not either, Dagan. However, if you look to the credit markets and the corporate bond markets, yields are blowing up. You've got corporate yields up at 8, 9, 10% on quality stuff. You have banks not loaning to each other. So I think the markets are telling us something. Bottom line, the money doesn't seem to be matriculating into the economy as quick as it needs to be at this point. So, to wit, if you look at these investments, these preferreds, take Bank of America, for example, that yields 5%. The market rate for Bank of America debt, something similar, is about 8 to 10%. Also, you would think there would be upside, or at least that's the way it was sold. Well, Bank of America would need to nearly triple to make 10% off that investment as a preferred. We'd be better off just nationalizing all these banks. In fact, it's estimated that the failure of a major bank would cost taxpayers $1.5 trillion. We could just buy out all these banks and financials for a third of that.
But, Robert, okay, I'll defend it. Everybody hates the bank bailout or the idea. You know, we get the viewer comments they write, and everybody, pretty most part, is angry. But we are a credit-based society. And if the banks, the biggest banks, cease to exist, won't that do more damage to the economy long term? We need somebody out there to move the money around.
We're not making an argument that banking should cease to exist. The situation seems to be that those running the banks aren't being bankers. I mean, look at what's happened here. Banks have become gigantic hedge funds, levered 25 to 1, twice, 3 times the normal limit. They're not doing banking things like normal underwriting and analysis of loans. They're offsetting their risk through complicated derivatives. That's not what banking is. Plus, the money's getting diverted. Citicorp, which, as we well know, got a lot of money and is being backstopped, one of their funds just made a major investment buying out a Spanish construction company. That doesn't seem to be going into the American economy.
Robert Maltbie of Singular Research. Robert, we appreciate your time today. Thank you very much.
My pleasure.
Appreciate it.